Okay, let's unpack this. We are diving deep into the financial blueprint of Avery Dennison Corporation.
Right. A global leader, materials science, digital ID solutions. Their stuff is pretty much everywhere.
Exactly. You interact with their products daily, sometimes without even realizing it. Our mission today is pretty surgical. Cut right through the complexities of their Q3 2025 earnings report
Yeah, navigating the JAP versus non-GAAP maze.
to really understand what drove their results and, crucially, what forces are setting the pace for them going forward, both internal and, external.
Well, the first thing that jumps out is this tension in the results. They called it a solid quarter.
Okay, what does solid mean in numbers?
Adjusted EPS of $2.37. That's up just 2% year over year,
Oh,
modest.
well, it's sales.
Net sales were $2.2 billion, so that's up 1.5% on paper, the reported number.
A bunch.
But here's the key number, I think, for assessing the underlying health. If you look at organic growth...
Stripping out currency acquisitions.
Exactly. When you look at organic growth, sales were essentially flat, 0% compared to last year.
0%. Okay, that flat organic number immediately tells you it's not simple growth across the board.
No, definitely not. It signals success is, well, highly segmented. Some parts doing well, others not so much.
And that seems to fit with the CEO, Deion Stander's comments. He mentioned being prepared for various scenarios.
Right, while also pushing two core strategies that sound a little contradictory at first glance, which are driving outsized growth in their premium, high-value categories.
Okay, focus on the fancy stuff.
And at the same time, really leaning on cost controls, productivity.
So this deep dive needs to figure out where those strategies actually landed. Which segment delivered? The legacy materials group or the more dynamic solutions group?
Absolutely. Let's start with the materials group, MG. That's the foundation.
The traditional labels, tapes, that kind of thing.
Exactly. And it's the bulk of the revenue, about $1.5 billion in sales this quarter.
And this is where that price pressure really hit, I gather.
Hardest, yeah.
And it's also where the reported versus organic numbers really diverge.
They do. Reported sales for MG looked okay, up 1.2%.
Fine on the surface.
But organically, the actual volume and mix performance, that was down 1.9%.
Down almost 2%. That's a pretty big gap between reported and organic.
It is. And that 1.9% organic decline, well, that tells the story of the macro challenge they're facing.
Why the decline?
The source material is clear. They had modest growth in volume and mix.
So selling slightly more stuff.
Right. But that was more than wiped out by deflation-related price reductions.
Ah, deflation. Input cost dropping. Raw materials.
Exactly. And market dynamics forced them to pass those lower costs on, cutting prices to stay competitive. So yeah, selling a bit more product, but getting less revenue per unit.
Okay, so battling deflation. That's always tough for a materials company. Where was the softness felt most within MG?
It was pretty broad-based, actually. Both the high-value category...
Including intelligent labels that sits within MG.
Yes, including that part. And the birds categories were both down low single digits.
Any specifics?
Graphics and reflectives were down low single digits, but performance tapes and medical, those were hit a bit harder, down mid-single digits.
Okay, wait a second. If prices are falling, organic sales are down nearly 2%, key segments are down mid-singles.
Yeah.
How on earth did they protect profit margins? That sounds like a recipe for margin collapse.
And that right there is probably the most impressive part of the MG story this quarter. Internal execution, it was stellar.
Stellar how?
Despite all that external price pressure, the adjusted EBITDA margin for the materials group actually improved. It was up 50 basis points to 17.5%.
Wow, okay. How did they pull off that trick? Better costs.
The magic word is productivity, just like the CEO flagged.
Wow.
That margin defense came mainly from successful internal cost control, supply chain efficiencies, restructuring benefits too.
So they use their internal levers, tight cost management, to fight the external environment.
Precisely. They executed exactly on that productivity drive. It really shows how well managed that materials group is, even when the top line environment is tough.
That is genuinely impressive, given those headwinds. Okay, let's pivot. Let's leave that world of efficiency and deflation and shift to the high growth engine, the solutions group, SG.
The digital identification, the branding side, smaller, $700 million in sales, but where the future focus seems to be.
And where the organic growth story should be much better.
And it is. This is where you see the payoff from focusing on those specialized high-value offerings.
So the number.
Solutions group sales were up 3.6% organically.
Okay, 3.6% organic growth. That's decent. That's differentiating from the materials group.
Definitely. And it gets really interesting when you drill down into the categories, especially those tied to digital ID that the market watches so closely.
Right.
Those premium digital drivers within SG, up high single digits overall.
And intelligent labels specifically, the RFID part.
That was up mid-single digits. Solid growth.
But you said high single digits overall for premium, so something else was really flying.
Yes. The true stars this quarter were Vestcom and Embelex.
Okay, remind us quickly what they do.
Sure. Vestcom is about in-store tech for retailers, shelf-edge pricing, signs, that sort of thing. Embelex does high-end branding for apparel, footwear, think complex logos, heat transfers, anti-counterfeit features.
Got it. And their growth.
Both were exceptionally strong, growing more than 10%, double digits.
Wow, okay, so Vestcom and Embelex are pulling up that average. That explains the high single-digit growth for the premium segment overall.
Exactly. Market demand is accelerating there, retail and supply chains are digitizing, and these businesses are right in the sweet spot.
There's always a but, isn't there?
Yeah.
You mentioned a critical nuance earlier. The margin story flipped.
It did. Here's the trade-off. Despite that fantastic top-line growth, the volume, the high-value mix, the adjusted operating margin for the solutions group actually contracted.
Down by how much?
Down 130 basis points. It dropped to 10.0%.
Ouch. 130 basis points is quite a dip, especially with sales growing like that.
Yeah.
Seems like a red flag given how much they're betting on SG.
Well, the documents suggest it's an investment hit, not necessarily a structural problem. It actually confirms that CEO comment about driving growth.
How so?
They did get benefits from productivity, like an MG, and from the higher volume,
Right.
but those gains were more than offset by higher employee-related costs.
So hiring, paying for talent.
Exactly. They're having to hire and likely pay up for the people needed to run these high-tech, fast-growing digital businesses. Think software developers, data scientists, specialized sales teams.
Right. You can't just snap your fingers and get 10% plus growth in areas like Vestcom and Embelex. You need the people.
Precisely. So unlike MG, where the focus was squeezing efficiency from an established setup, SG's rapid growth required significant investment in human capital.
So the margins drop because they're deliberately fueling that strategic expansion.
That seems to be the story. It's a trade-off investors often accept if they believe the top-line growth is sustainable.
That makes sense. Okay, provides clarity on the operations.
Yeah.
Now, let's connect this growth strategy to the balance sheet. Capital allocation was flagged as key. How are they using their cash?
Aggressively, but also disciplined, I'd say. Year to date through Q3, they returned a pretty substantial amount to shareholders.
How much?
$670 million through both dividends and share buybacks.
$670 million back to shareholders. That shows some serious confidence.
It does. On the buyback specifically, they spent $454 million to repurchase 2.5 million shares.
Reducing the share count.
Right, bringing the total count down by 3.1 million compared to last year. That buyback effect is another lever boosting the EPS growth, even with flat organic sales.
And the debt picture, still healthy.
Looks solid. Net debt to adjusted EBITDA is around 2.2x. That's quite manageable, especially given the cash returns.
But they're also gearing up for more moves, right? I saw something about a bond issue.
Yes, good catch. In September, they issued $500 million in senior notes, due 2035 at 4.00%.
€500 million. What's that earmarked for?
General corporate purposes, but explicitly including financing acquisitions. They were loading up the war chest.
And did they use it quickly?
Immediately. Shows clear intent to grow externally, too. Just after the quarter ended, October 20th, they closed a significant deal.
Which one?
They bought the U.S. flooring adhesives business from Meridian Adhesives Group. It's mostly known as Taylor Adhesives.
Okay, Taylor Adhesives. Let's nail the specifics. Price tag.
Pretty hefty. $390 million.
And what does it bring in revenue?
The projection for 2025 is about $110 million annually.
Okay, so $390 million for $110 million in revenue. That's a large deal. And adhesives. That sounds firmly like traditional material science back in the MG world.
It does. It's an interesting strategic move, adding scale in that area.
And just to circle back quickly on costs before we look ahead.
Yeah.
You mentioned restructuring savings earlier.
Yeah, it's worth highlighting, again, tying back to that MG margin performance. Year to date, the company realized about $48 million in pre-tax savings from various restructuring actions.
So that productivity push isn't just talk. It's generating real cash savings.
Measurable financial gains, yeah.
Yeah.
Helps buffer those pricing pressures in MG, and you could argue helps fund the investments needed in SG.
Okay. So We have this tale of two quite different operating segments under one roof. One mastering cost control amid deflation, the other investing heavily for rapid digital growth. What does this all mean for the end of the year? Let's wrap with the outlook.
Management seems confident about Q4. They're guiding for adjusted EPS between $2.35 and $2.45.
So maintaining momentum, basically, even while they start integrating Taylor adhesives and keep pushing that digital growth.
Seems to be the plan. But, while the number looks stable heading into Q4, it's crucial for listeners to remember the context.
The risks.
Always.
Yeah.
The official filings lay out numerous risk factors. They operate globally. Things are complex.
Like what, specifically?
Geopolitical instability is high on the list.
Yeah.
Trade issues, reliance on China, the ongoing impact of conflicts like Russia-Ukraine and Israel-Hamas. Also, the cost and availability of raw materials, that's always key for them.
And integrating that big new acquisition.
Absolutely. Executing and integrating acquisitions smoothly, like Taylor adhesives, is highlighted as a specific challenge. It's never guaranteed.
Okay, so summing up this deep dive, Q3 was really about two different stories. You had the materials group successfully fighting off price deflation, protecting margins almost entirely through really strong internal productivity.
Right. Impressive cost control.
Meanwhile, the solutions group was the growth engine, delivering solid organic growth, especially led by those specialized digital ID techs like Vestcom and Emblex.
The double-digit growers.
Even though achieving that growth meant taking a hit on margins due to higher employee costs. Investing in talent.
That captures it perfectly. It's a balancing act.
So connecting it all together, here's the final provocative thought for you, the listener, to chew on.
Okay.
We saw the company take on fresh debt, that $500 million, specifically to fuel expansion. And they immediately spent a large chunk, $390 million, on Taylor adhesives, a traditional materials business.
Right.
Now, given how critical the digital segments are to their growth story, Vestcom, Emblex, growing over 10%, what impact will this big, materials-focused Taylor acquisition, with its $110 million revenue stream, have on Avery Dennison's overall organic growth profile heading into 2026?
Yeah, that's the question. Will adding more traditional materials dilute the focus, maybe even slow down the overall organic growth rate perception? Or is it just a smart move to add a stable cash flow engine that ultimately helps fund the next wave of high-tech digital innovation? Something to watch.